Hi, in this video, we're going to see how to calculate the monthly payment from an amortized mortgage. So suppose you take out a mortgage here with a principal payment of £1 million, which is the total amount of loan here. And the bank is offering you 6% of annual percentage rate. And you're going to pay back the loan in 20 years' time. But that 6% is not the discount rate that we're going to use here because it's annual percentage rate. And we're paying monthly mortgage payments. So we need to make a bit of adjustments to the discount rate here. Okay? So how many installments here are we paying if we're just paying monthly mortgage? There will be 20 years times 12, which will be 240 months or periods here. Okay, so T here is actually not 20 years but 240 months because that's monthly payment. Okay, and what is the appropriate discount rate here? Since we're paying monthly, not annually, so the R here is actually 6% divided by 12, which is 0.5%. Okay, so we're now trying to calculate the monthly payment, which is the reoccurring cash flow that we're paying into the bank. But what is the present value of all our payments? It is exactly the principal here, which is the total amount of loan that we're borrowing from the bank. So the present value of all the payments is actually just £1 million here. Okay, so we're basically asking the question how to calculate the C in the annuity formula, knowing the present value, knowing the discount rate, knowing the periods or total periods, which is T here. Okay, so we can just plug these numbers back into the annuity formula. So remember the annuity formula here. So the annuity formula is C over R, 1 minus 1 over 1 plus R to the power of T. Okay, so with these numbers, we can just put all the numbers back to the formula here. And so we have 1 million is C, which is the answer that we want, divided by 0.5% and times 1 minus 1 over 1 plus 0.5% to the power of 240. Okay, and then we solve for C here. Okay, so if you plug these numbers back to your calculators, then you can see C is actually 7,164.31 pounds. Okay, so it means that we have to pay back at each month, at the end of each month, this amount as a mortgage payment, which is 7,164.31 pounds. Okay, so this is how we calculate the monthly payments. But if you want to know more in-depth payments, like how much among this monthly payment is consisted of interest and how much is consisted of a principal payment, right? So we need to know more information, not just the monthly payment. So for example, how do we calculate any installment or any payments, principal payment and interest payments? So for example, we use the 61st payment as the example here. How much within this 61st payment is paid to the principal and how much of it is paid to as an interest? Okay, so if you're about to pay the 61st payment, it means you have just paid the 60th payment. So we need to shift our time perspective to the 60th periods. Okay, so how many payments are we left with? We're only left with 180, right? So T here would be 240 minus 60, and we're left with 180 installments or payments or periods to be paid. Okay? And we still have the same discount rate, which is 0.5%. Okay? And we know that our monthly payments, our amortized mortgage is 7,164.31, right? So what we need to know is that how much of the principal is still left after we have just paid the 60th installment here. Okay, so again, we use the annuity formula. Okay, But remember, there are no longer 240 periods or installments here because we've just paid the 60th one. Okay, so it's C over R again, 1 minus 1 plus R to the power of T here. Okay, so you plug in the numbers, you have 7,164.31 divided by, here 0.5%, and 1 minus 1 over 1 plus 0.5% to the power of 180. Okay, so this will give you roughly 848,995.92 pounds. Okay, so this is how much of principal that we've left with just after 5 years of payment, which is the 60th installment, right? So we'll pay interest depending on the principal we're left with, right? So the interest payment is always going to be the interest rate multiplied by the principal of the balance, okay? So the interest payment here, interest payment for the 61st payment here would be 848,995.92 multiplied by 0.005. Again, it's monthly, right? So you'll have 4,244.98 pounds. Okay, so that's your interest payment from this 61st installment. Okay, so how much is paid to the principal? You can just find out the difference between the monthly payment and the interest payment, which is going to be 7,164.31 minus 4,244.98. Okay, so you can plug this thing into your calculator and you have the answer, which is 2,919.33 pounds. Okay, so this gives you an idea how to calculate each monthly payment's components here. So how much has been paid to the principal and how much has been paid to the interest. You can do any installment in a similar way. So for example, the 80th, 100th, or any number you can think of that's within 0 to 240, right? So you just have to calculate how much of the remaining balance or the remaining principal in terms of the present value at that time point, and then you calculate the interest based on the interest rates multiplied by the remaining balance, and the rest of your payment, which is your monthly payment minus your interest payment, will go to the principal repayment. Okay, so now you know how to calculate and analyze the payments of the mortgage or amortized mortgage. I'll see you in the next video.